Most people believe that the biggest corporations in America pay the biggest share of taxes, but what if that belief is completely wrong? What if some of the most profitable companies on earth legally pay less tax than a middle-class family? That idea sounds shocking, maybe even impossible, yet it is not only real, it is built into the system itself. Today, we are pulling back the curtain on how big corporations avoid taxes legally, and by the end of this video, you may never look at a corporate logo the same way again. Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. To understand how corporations avoid taxes today, we need to go back in time, long before modern tech giants and global brands existed. In the early days of the United States, taxes were simple. Businesses were small, mostly local, and profits were easy to track. Governments taxed land, goods, and basic income, and there was little room for creative accounting. Corporations as we know them today did not yet have the power or influence to shape the rules. As the Industrial Revolution took hold, companies grew larger, richer, and more complex. Railroads, steel manufacturers, and oil companies began operating across multiple states. Suddenly, governments faced a new challenge. How do you tax a company that operates everywhere at once? This is where the first cracks appeared in the tax system, and those cracks would slowly widen into loopholes. By the early 20th century, corporate taxes became a major source of government revenue. Lawmakers wanted corporations to contribute fairly, but they also feared driving businesses away. To balance these goals, they introduced deductions, exemptions, and incentives. These were meant to encourage investment, job creation, and innovation. At the time, these ideas sounded reasonable and even beneficial, but here is where the story takes a turn. Every deduction created complexity, and complexity created opportunity. Corporations hired lawyers and accountants whose sole job was to study the tax code line by line. If the law allowed a deduction, they would use it. If it allowed a delay, they would delay. Over time, paying less tax became not just a benefit, but a strategy. Fast forward to the post-World War II era, when multinational corporations began expanding globally. Factories moved overseas, supply chains stretched across continents, and profits flowed through dozens of countries. Tax laws, however, were still written as if businesses stayed within national borders. This mismatch between global business and local tax rules became one of the biggest advantages corporations ever received. Imagine a company that designs products in the United States, manufactures them in Asia, and sells them in Europe. Where should the profit be taxed? This question sounds simple, but the answer is anything but. This practice is legal, and it is one of the most powerful tools corporations use today. One of the most common methods is called profit shifting. Here is a simple example. A U.S. company owns a subsidiary in a low-tax country. That subsidiary owns the rights to the company's brand or technology. The U.S. company then pays huge fees to use those rights. On paper, the U.S. company makes less profit, while the subsidiary makes more. The result is lower taxes overall, without breaking any laws. This brings us to tax havens, a term you have probably heard but may not fully understand. Tax havens are countries or regions with very low corporate tax rates and strict secrecy laws. Places like Ireland, Bermuda, and the Cayman Islands became famous for this. Corporations are not hiding money under mattresses there. They are following legal structures designed to minimize taxes. One of the most famous strategies was nicknamed the Double Irish with a Dutch sandwich. The name sounds almost funny, but the impact was massive. Companies routed profits through Ireland, then the Netherlands, and finally into tax havens. Each step followed legal rules, and each step reduced the tax bill. Eventually, governments noticed, but by then billions of dollars had already moved. You might be wondering why governments allowed this to happen. The answer is complicated and uncomfortable. Countries compete with each other for investment. If one country raises taxes, corporations threaten to move jobs and money elsewhere. This creates a race to the bottom, where countries lower taxes to stay competitive, even if it hurts public services. Through lobbying and campaign donations, they help shape tax laws. This created a system where the people writing the laws were sometimes guided by those who benefited most from them. Now let's talk about deductions, another major piece of the puzzle. Corporations can deduct expenses just like individuals, but on a much larger scale. Interest payments, depreciation, research costs, and even executive compensation can reduce taxable income. In some cases, companies report huge profits to investors while reporting little or no profit to the tax authorities. A well-known example involves depreciation. When a company buys equipment or property, it can deduct the cost over time. But tax rules often allow accelerated depreciation, meaning companies deduct large amounts upfront. This reduces taxes today, even if the asset generates income for decades. The timing difference alone can save millions. Then there are tax credits, which directly reduce the amount of tax owed. Credits for research and development, renewable energy, and hiring certain workers are meant to encourage good behavior. And sometimes they do, but large corporations with massive legal teams are far better positioned to claim these credits than small businesses. Another powerful tool is loss carryforwards. If a company loses money one year, it can use that loss to offset profits in future years. When the economy recovers, they use those losses to avoid taxes just as profits return. This can stretch on for years. Let's not forget stock-based compensation. Many executives are paid in stock rather than cash. For tax purposes, companies can deduct the value of stock compensation as an expense, even though it does not require cash. This reduces taxable income while still rewarding top executives generously. You might think that all of this sounds unfair, and you would not be alone. Public outrage has grown as reports revealed that some highly profitable corporations paid zero federal income tax in certain years. These stories spark anger, but they also raise a deeper question: is the system broken, or is it working exactly as designed? The breaking point came after the global financial crisis. Governments needed money to bail out banks and stimulate economies. At the same time, corporate tax avoidance became impossible to ignore. Investigations, leaks, and whistleblowers revealed the scale of the problem. Names, numbers, and documents made headlines around the world. In response, governments promised reform. International groups proposed minimum global tax rates. Some loopholes were closed, and certain strategies were restricted. But corporations adapted quickly. New structures replaced old ones, and the cycle continued. The rules changed, but the game remained the same. This brings us to the present day. Modern corporations operate in a digital economy. They sell ads, data, and subscriptions across borders without physical presence. Traditional tax rules struggle to keep up. Governments argue over who has the right to tax digital profits, while corporations continue to exploit the gaps. Here is the part that directly affects ordinary people. When corporations pay less tax, governments still need revenue. That money often comes from payroll taxes, sales taxes, and property taxes, which fall more heavily on individuals. Think about your own paycheck. Taxes are withheld automatically. There is little room to maneuver. Compare that to a multinational corporation with thousands of legal entities and advisors. The difference is not intelligence or effort. It is access and scale. So what are the real consequences? Fewer resources for schools, infrastructure, and healthcare. Greater inequality, a sense that the system favors the powerful. These outcomes are not accidental. They are the result of decades of choices, compromises, and incentives. Before we wrap up, let's pause and reflect on 3 key takeaways. First, most corporate tax avoidance is legal, not illegal. It exists because laws allow it. Second, complexity benefits those who can afford experts, widening the gap between large corporations and everyone else. Third, without coordinated global reform, the same patterns will repeat again and again. The warning is clear. If tax systems do not evolve with modern business, public trust will continue to erode. The open question is whether governments and citizens will demand meaningful change, or whether the system will keep drifting further out of balance. If this topic surprised you, that reaction is exactly why these conversations matter. Understanding how the system works is the first step toward holding it accountable. Stay curious, stay informed, and remember that what happens in corporate tax offices eventually affects all of us. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.